Navigating the tax implications of an inherited IRA and making charitable donations can be a complex process, but done strategically, it can result in significant tax savings. The key is understanding the rules and opportunities surrounding these financial instruments. When you inherit an IRA, it's crucial to understand the required minimum distributions, RMDs, that must be taken. The timing and amount of these distributions will vary depending on your relationship to the deceased and their age at death. Spouses have more flexibility when it comes to RMDs and can even treat the IRA as their own. Non-spouses, on the other hand, typically must start taking RMDs by December 31st of the year following the IRA owner's death and are subject to the 10-year rule if the original owner passed away in 2020 or later. If the inherited IRA is a traditional one, RMDs are taxable as income. This is where strategic planning can help manage the tax burden. By donating these RMDs to a qualified charity, you can utilize the Qualified Charitable Distribution (QCD) mechanism, effectively reducing your taxable income by the amount donated, capped at $100,000 per year. The QCD strategy is a direct transfer of funds from your IRA custodian to a qualified charity. Notably, this approach bypasses your income statement entirely, meaning it does not count as income nor as a tax deduction. It simply lowers the amount of your taxable IRA distributions. Another aspect to consider is the timing of your charitable donations. Bunching donations, or combining several years' worth of charitable giving into one tax year, can help you exceed the standard deduction and itemized deductions on your tax return. This approach can provide a greater tax benefit in the year you itemize, but it requires careful planning to ensure it aligns with other tax strategies you may be using. Charitable remainder trusts, CRTs, are another valuable tool in the context of inherited IRAs. By naming a CRT as the beneficiary of an IRA, the trust can receive the IRA distribution upon the owner's death. The beneficiaries of the trust then receive a fixed percentage of the trust's assets each year, while the remainder is donated to a charity of your choosing after the trust term ends. This approach offers tax benefits as the donation to the trust qualifies for an estate tax deduction, and the distributions to the beneficiaries can be structured to provide a steady income stream, potentially at a lower tax rate. It's also important to consider the impact of state taxes on inherited IRAs and charitable giving. Not all states follow federal tax rules, so the state tax treatment of IRA distributions and charitable contributions can vary. Consulting with a tax professional who is knowledgeable about the specific rules in your state is essential to maximize tax savings. Finally, when planning for charitable giving with an inherited IRA, always ensure that the charity is a qualified 501(c)(3) organization and that you obtain the necessary documentation for your contribution. This will ensure that your donations are tax deductible and in compliance with IRS regulations. Combining smart inherited IRA planning with charitable donations can offer an effective way to manage and potentially minimize taxes. By leveraging QCDs, bunching strategies, CRTs, and understanding the interplay between federal and state tax rules, you can optimize the tax benefits of your inherited wealth and support the causes you care about.